It's human nature to want to sell when things are going down and buy when they're going up. In fact, people feel the pain of losing money twice as much as they feel the pleasure of gaining money. That's why some panic during market downturns. Human emotion has evolved over millions of years to protect us, but when it comes to investing, that emotion seems to work against us. Hi, I'm Patrick Minsky, certified financial planner and private wealth manager at Experience Wealth Management. Here are 7 principles that can help you stay on track and fight the urge to make emotional decisions during market turmoil. These principles come from a recent article from American Funds called How to Handle Market Declines. The first principle: market declines are normal and a natural part of investing. There are 3 major categories of downturns. They're called dips, corrections, and bear markets. The first are called dips, and they're defined as a downturn of 5% or more from a market high. On average, these happen about 3 times a year and last for just over a month. The second category are called corrections. These happen on average 1 time a year and last for about 3 months. And the third and less frequent are called bear markets. This is when the market is down by 20% or more. On average, they take place about once every 6 years, and it takes just over a year to recover. However, what's important to note is that each past dip, correction, and bear market has been followed by a market recovery to a new all-time high. Second principle: it's time in the market, not market timing, that matters. No one can accurately predict in the short term where the market is going. Jumping in and out of the market or sitting on the sidelines can be very costly. Even missing out on just a few trading days can drastically reduce your return. That's why a sound strategy in a volatile or down market is to stay with your plan and continue your strategy. Third principle: emotional investing can be hazardous. Humans are emotional beings, as I mentioned earlier. However, successful investing involves rational decisions. Fourth principle: have a plan and stick to it. Your plan should take into account your risk tolerance, your short-term and long-term goals, and a well-crafted plan should also take into account those dips, corrections, and bear markets that are going to happen in the future. 5, diversification matters. A diversified portfolio lowers risk by spreading out investments across a variety of investment classes. Although diversification does not guarantee profits, it can buffer the effects of volatility on portfolios. 6th, fixed income can bring balance. Stocks are the building blocks to a portfolio that give you growth over time. Bonds can provide an important counterbalance. That is because bonds have what is called a low correlation to the stock market. In other words, bonds can zig when stocks zag. Having a higher proportion of bonds relative to your stocks can reduce your risk, but it also can reduce your return. 7th and final principle: the market tends to reward long-term investors. Remember that. Although stocks may rise or fall significantly in the short term, they tend to reward investors over the long term. In fact, when looking at all 10-year periods, all the way from 1937 to 2019, stocks have returned on average 10.47%. That's almost 10.5% per year. During periods of crisis and market volatility, it's normal for emotions to bubble up. However, investors that can tune out the news, focus on their long-term goals, and stick to their plan are better positioned for success. There you have it, the 7 essential principles of market downturns. If you'd like a copy of the article that this video was based on, please let us know. And I'm Patrick Minsky, certified financial planner and private wealth manager at Experience Wealth Management. And just remember, when it comes to your finances, we got your back and we aim to keep you on track.